In the world of finance and investment, history often serves as a guiding light, offering insights into the future through the lens of the past. Welcome to FatCity Finance. Today, we find ourselves at a critical juncture as the U.S. money supply is contracting for the first time since the Great Depression. We're witnessing the first decline in M2 money supply of at least 2% since 1933. This unprecedented event is sounding alarm bells that could have far-reaching implications for both the economy and the stock market. The two U.S. money supply metrics that investors tend to pay close attention to are M1 and M2. The former accounts for cash and coins in circulation, as well as the demand deposits within an individual's checking account. Meanwhile, M2 factors in everything in M1 and adds money market accounts, savings accounts, and certificates of deposits below $100,000. The main difference is that M2 factors in cash that takes a little extra work to get your hands on. The money supply, particularly M2, has long been a vital economic indicator reflecting the availability of cash and liquidity in the financial system. Generally, as the U.S. economy steadily grows over time, it's natural that more cash and capital is needed to facilitate transactions. However, the recent decline in the M2 money supply is such a rare event that it demands further attention. As of July 2023, it was 3.69% below the all-time high recorded in July of 2022, marking the first meaningful contraction since the Great Depression. Let me repeat that, marking the first meaningful contraction since the Great Depression. While some argue that this contraction could be a natural correction following a period of historic expansion, history suggests otherwise. To understand the gravity of this situation, let's take a journey through history. Over the past 153 years, there have only been 5 instances where M2 declined by at least 2% on a year-over-year basis. The 1870s, 1893, 1921, 1931 through 1933, and now in 2023. Each of these instances was accompanied by depression, panic, depression, Great Depression, and whatever we will call the next few years. All resulted in double-digit unemployment rates. The 1870 and 1893 contractions occurred before the establishment of the Federal Reserve, and the 1921 and Great Depression contractions followed its creation. Today, we possess a better understanding of monetary and fiscal policy, which may help mitigate the worst outcomes. Nevertheless, history tells us that significant M2 contractions have historically signaled depressions and economic crises. For investors, this contraction raises red flags. While there is no crystal ball for predicting stock market movements, certain indicators, such as the M2 money supply, have demonstrated remarkable correlations with market direction. Historically, a declining M2 supply has been the equivalent of very dark clouds forming over Wall Street. Moreover, with the core inflation rates currently more than double the Federal Reserve's target rate of 2%, a decrease in circulating capital could potentially lead to a deflationary recession. As investors, it's essential to recognize that time is on our side. Being vigilant and informed about economic indicators like money supply can help us make more informed investment decisions and navigate the unpredictable waters of the stock market. This is something that bears close watching. It's crucial to acknowledge the differences between today's economic landscape and those of the past. We now have a better grasp of monetary and fiscal policies, allowing for quicker responses to economic challenges. Multiple rounds of fiscal stimulus during the COVID-19 pandemic also led to a huge surge in M2 money supply, raising the question of whether the current decline represents a return to normalcy after historic expansion. No matter how we frame it, dropping from an expansion of 26% in 2021 and 12% in 2022 to a contraction of 3.69% in 2023 is going to feel like the financial equivalent of the world's biggest wedgie. In the world of finance, history often serves as a sobering reminder of the past impact on the present. The recent contraction of the U.S. money supply, a phenomenon not seen since the Great Depression, should serve as a stark warning to investors and economists alike. While there are differences in today's economic landscape, the historical pattern suggests we should proceed with caution. As we navigate the uncertainties of the financial markets, staying informed and vigilant is our best defense. The contraction of the M2 money supply may be an ominous sign, but it also represents an opportunity for investors to prepare for potential economic challenges and make strategic decisions that safeguard their financial future. In these uncertain times, knowledge and preparation are key. Be sure to do your own research and stay informed. If you enjoyed this video, please like, subscribe, and ring that notification bell to stay up to date with all of our latest videos. Thanks for watching, and as always, happy investing!